My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer Arca. I'll be with my friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. For the first time I can recall, we're in a vast slowdown within a titanic boom. It's such a riddle wrapped in a mystery inside an enigma. I can't see it any other way, including on a day like today. This is where the Dow dipped 135 points, S&P declined 0.61%, Nasdaq lost 0.63%, but it felt much worse than that. Right now, the data is so contradictory. We can't tell either way, but this paradox will ultimately get resolved over time. Unfortunately, for some ill-advised reason, we might not have time. There are only 2 weeks before the next Fed meeting, and as far as I can tell, there are plenty of Fed heads who believe they need to keep raising interest rates rather than to take their time to assess the situation. They don't want to wait. They simply want to tip us into a definitive recession. I think their view is reckless, simply because we're in an incredibly strange situation, and we don't have all the facts. Maybe the Fed needs to tighten more. But would it kill them to wait another month or two? Prudence is called for right now, not recklessness. That's what you do when you're confused. You don't take action. We know there are a bunch of inflation hawks in the Federal Reserve, including Loretta Mester, president of Cleveland Fed. She's a non-voting member this year, but she's incredibly influential. Susan Collins, president of Boston Fed, also a non-voting member. Michelle Bowman, Fed governor from Kansas, who is a voter. They've all commented that residential real estate is too high. They think the economy's too hot. I get that. In remarks to Reuters that were published yesterday, Neil Kashkari, smart guy, president of Minneapolis Fed, he said, quote, if I had to err, I would err on being a little bit too aggressive in terms of bringing inflation down, end quote. 9 days later, St. Louis Fed President James Bullard said, we need not one but two more rate hikes. I greatly respect these people. I see where they're coming from. Housing prices are relentlessly going higher, as are rents. We still have far more jobs than potential workers, according to the Jobs, Openings, and Labor Turnover survey we got today. I expect unemployment to hover around 50-year lows when we get the Labor Department's non-farm payroll number Friday morning, 8:30. So, yeah, if you look at wage data, housing data, the economy is booming. Fed clearly needs to cool things down. Hey, why don't you throw in the thriving travel and leisure sector, and you think money grows on sequoias. When American Airlines raised its forecast this morning, you can't ignore that detail. But outside of those areas, everything else has gotten soft. Sell. Everything. And to the point where I'm thinking maybe the strength in housing and wages should be tempered by the data from everything else. I'm not saying the inflation hawks are wrong. I just hope they'd agree with Philly Fed President Patrick Harker today, who admitted that, well, the economy's resilient, but maybe they should skip in meeting hikes. In other words, maybe not do the next hike in June. Just try to resolve the boom-bust paradox first. I think that's wise because increasingly so much of the data is just so darn weak that you could believe we might be on the verge of recession right now. Let me give you how I think things shake out here so you know exactly what I'm talking about. First, commodity prices, well, they've just been ridiculous. How bad? Plummeting. Plummeting in waste is totally in sync with the recession. Oil and natural gas keep getting crushed, the latter bouncing around levels that signify a severe slowdown. Copper's awful, too. I bet we aren't near the bottom. Second, we're beginning to see a total breakdown in retail, with truly discouraging earnings and almost uniformly tepid forecasts. The retail stock charts are so severely damaged, you can't ignore the weakness. Memo to Fed. Please make some calls to big brick-and-mortar retailers. You will know exactly what I mean if you do that homework. Third, today we got a dreadful quarter from an outfit called Advance Auto Parts. I follow it. It's a consistently strong company. It's now signaling a vast slowdown in the auto business, which had been a beacon. The stock lost 35% of its value in a single session. I can't find any justification for its huge shortfall and hideous forecast, as well as an astonishing 83% slashing of its dividend, other than a severe slowdown in auto sales. They've been previously a beacon of strength. We'd be nuts to ignore what they had to say today. Fourth, we know that terrible food inflation has been with us for ages. But did any of the Fed chieftains listen to Rich Galanti, the genius CFO of Costco, when he just spoke? You know what they'd hear? They'd hear this quote. Inflation continues to abate somewhat. You go back a year ago to the fourth quarter of 2022. Last summer, we had estimated at that time that year-over-year inflation was going to be up 8%. And by Q1 and Q2, it was down 6 to 7%, and then 5 to 6%. In this quarter, we're estimating the year-over-year inflation to be in the 3 to 4 range, 3 to 4%. That smells like panic to me if you cut it. That trajectory is so positive. Now, let's think about this. Costco's perhaps the best gauge of these things. They offer the best prices, and anyone can join. They're the arbiter of tens of millions of Americans. According to them, the direction is clear. Food inflation is rapidly diminishing. Fifth, the banks. A few months ago, we had banking mini crisis clustered among a very few aggressive regional outfits. Very bad. It rocked the financial system, and it's still being felt as banks that I talk to have to cut back on lending and are taking less risk. There's a loan pipeline that was going full tilt as late as April, but that has now been curtailed, perhaps dramatically. Banks don't want to make mistakes. They get them crushed by the bank examiners, who suddenly are exercising a lot of caution. You may not be able to see it happen, but if you talk to bank CEOs and loan officers, as I hope the Fed does, you know the tenor is much more restrictive and negative. And then there's the border issues, like China. The Chinese economy has slowed so dramatically, you could argue that vast locomotive of global growth could be undergoing a severe contraction. You know, we only call it contraction because it's China. And China's not a free market economy. It's a command economy. They should be able to just order an expansion, but they haven't been able to. Or there are these rolling firings in tech and finance. They're quiet. They aren't broadcast, except the huge layoffs done by an outfit like Meta, yes, because Mark Chainsaw Zuckerberg fired a quarter of his workforce, touted the year of efficiency. But the layoffs are happening, and they could get very severe very quickly if we just wait 4 or 5 weeks for things to play out. Again, the cadence is quickening. Things are getting worse. They're getting worse faster, which is why it makes sense for the Fed to pause a little bit before making its next move. I'm seeing the same thing play out at the major banks. It's dismal, worse since 2009. Remember, Zuckerberg cut back from where he hired in the pandemic. There are so many other firms, if they started doing that, look out below. It's truly a tough moment because we've got a major housing shortage courtesy of 15 years of underbuilding. Yet the Fed wants homes built now and prices lower now. You can't do that. While there's no fixing supply side anytime soon, I think we get less demand for housing the moment Biden's freeze on the student loan repayments goes away. At the same time, mortgages are priced off long-term interest rates, and the Fed's latest hikes have done nothing at all to take long rates higher. So why the heck bother? Now, we got the Fed's monthly summary at 2 p.m. today, known as the Beige Book, and it showed prices rising moderately over the reporting period, though the rate of increase slowed in many districts. Just wait till it starts going down, not rate increase, but down. Given this body of evidence, is it really worth it to raise interest rates in order to cool down housing? When recent rate hikes haven't done a thing to make mortgages more expensive, does it really make sense for the Fed to spur on more layoffs when the layoff wave's already going? Here's the bottom line. I think both of these fears need to be tempered by time, because right now we don't know whether the Fed's winning or losing. So why not wait? Beats the heck out of me. Matt in North Carolina. Matt.
Booyah, Jim.
Booyah, Matt.
First-time caller, long-time follower. I had a question about Devon Energy. I have 400 shares at a cost basis of around $65. I want to know, should I hold, sell, or buy more?
I don't like oil. We have underweighted for oil in the Chapel Trust. Sometimes I wish I had none. I think oil goes lower. That's what I know. Michael, Rhode Island. Michael.
Hey, Jim, my son has a question for you.
Sure, put him on.
Hello, Mr. Cramer. I was wondering, as a beginner investor, if United Airlines would be a good stock to buy because it's undervalued and a lot of people travel in the summer.
You know what? I like your logic. Would it be my first choice? No, the airlines have a history of not making a lot of money. But who am I to discourage this young lad who is doing the exact right thing and thinking about what are the fundamentals? I like that. Get started small, and then we build. How about Jerry in Missouri? Jerry.
Hey, Jim, thanks for taking my call.
Of course.
This technology/energy company got hammered last quarter after missing expectations. Last week, it was up almost 8% with a lot of the other NASDAQ leaders. Do you think that in-phase energy has been published enough and will return to the 200s?
I think it's too low. I understand they missed the quarter. A lot of people feel they're really a finance company, not an energy company. I think they're a bit of both. I think it's time to buy in Phase Energy. Small, but I would buy it. Joseph in Washington. Joseph.
Hi, Jim. Thanks for taking my call.
Of course,
Joseph.
So
Macy's has been having a tough start to the year. Just hit a new 52-week low today, approaching a 5% dividend yield, and it's approaching tomorrow. At these levels, do you think Macy's is sufficiently de-risked to initiate a position?
All right, this is a great question, and here's the answer. I could say yes, and that stock could go down another 50 cents tomorrow. There is no bid for any retailer. No bid, meaning no one's trying to buy them. Do I think it's inexpensive? That's the best I can do, and the answer is yes. That may not be enough. Too hard. All right, listen, right now we don't know if we're winning or losing. We don't know if the Fed's got it right or wrong. So doesn't it make sense to pause? Wouldn't that be the prudent thing, not the reckless thing? Why not wait? Mad Money tonight. Last month, we profiled a company called New Fortress Energy, and we were compelled by the natural gas infrastructure play. So tonight, we're going straight to the source, digging the real story. Then Applied Materials is riding the AI wave up nearly 10% this week. I'm finding out more about what the company's pipeline is with the CEO. And Salesforce reported at the bell with a secret AI kicker. Was it a needle mover, or are people just dumping the stock because it's been so red hot? Hey, why don't we talk to Mark Benioff before we take action? So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.